That's true, and that's you know, as he points out, that's another reason why you want to keep an eye on the dollar. And all this, you know, there's a lot of confusion out there, and this is very typical as you get close to a bottom, is that the bulls and the bears start to fight it out. And I think, you know, if you see these markets, they've pulled back quite a bit, and it's what you realize is at a top of a market, the bulls and the bears are fighting it out, and the bears finally won because you start to see the data come in that this bull market is over, and that you start to see what they call, you know, lower tops and lower bottoms, and that is one of the signs of a bear market. But as you start to find, what's really interesting, you know, what led us down was housing and banking, and some of the consumer stocks, and the housing stocks peaked around 2006, and they probably bottomed a couple of months ago. And what's kind of interesting, and what makes me excited, and why this is all important, is because when these markets pull back and we have these bear markets, it really creates tremendous opportunities for investors, because you have this tremendous opportunity to buy low and potentially sell high later on. So, you know, people like me that have been around a little while, that have some experience, you know, it's kind of perverse, but we like these difficult markets where the prices pull back. There's a lot of pain, economic pain. People are losing jobs, people are losing their homes, but from an investor point of view, people dump their stocks, and you have an opportunity to buy at significantly lower prices. And you can see in housing that it took about 2 years for them to bottom. Normally it doesn't take that long because there's severe problems there, but you can see that they probably bottomed a couple of months ago, and now, and I'll give you an example, Pulte Homes was about $8 at the beginning of the year, and it went up to $17, and now it's back up to about $13 or $14. So it's up about 50%. So you're starting to see some of these things bottom, and they let us on the way down, and now you kind of see them stabilizing. If you look at the earnings, you can see the earnings are still really bad, but you can see some improvements. And so all the bad news is out on those. So what we're hoping to see is that you're going to see that in the rest of the other sectors.
So Dan, it sounds to me that you buy the concept that stocks and indexes can be leading indicators, and that even though the news is still bad, maybe it's time to begin nibbling a little bit.
Absolutely, absolutely. You know, as they say, they're not going to ring a bell at the bottom, but you know, guys like me, we wait, you know, 3 or 5 years for these opportunities, and we want to try to grab it. And you know, there's all sorts of strategies out there. I don't know what strategy you might have or what you might have, but personally, you know, I've been through this so many times, so many cycles, but at the top, you can see it happening, and it takes a little while to build that top. And you can, you know, there's several things that you see from a technical point of view. Once you break a 200-day moving average line, 200 days is a long-term trend. And when you break that, that means that trend is over. And that's a significant event. Even fundamental people look at that. And a lot of stocks and industries and indexes have broken that. And that's a telltale sign. There's also long-term trends from a technical point of view. But also, too, if you look at some of these stocks, they're up 100, 200, 300% from the start of the bull market that started in 2003. It actually bottomed in 2002, but we really didn't break out of that particular bear market till 2003. So a lot of these stocks are up over the last few years, 200, 100, 300%. So they were profit taking, and that cycle was over. So you pull back and you wait for this opportunity to buy.
But in fairness, earnings have also been up in those years from 2003 to date.
Oh, absolutely, absolutely. And the earnings in some of these sectors that I talk about in banking and housing, they've been horrible, horrible, especially in housing.
So we're going to get easy comps, too, coming out as we move forward.
Very true. That's kind of what I mentioned. The earnings still look bad, but they're certainly improving. They're really improving dramatically.
Let's let our viewers know what we meant by comps, meaning that if this year a company's earning $1 a share, and that's depressed from $1.50 to $2 in the prior year, the next year, if they do $1.20, they've increased their year-on-year comp or earnings.
Yeah,
so,
and for the banks and the housing stocks, it's even worse, where they had significant losses, and now those losses are starting to be minimized, and even a year out, 2 years out the road, where they're starting to get profitable again. And so the market's very anticipatory, and you can't wait till it actually happens. You have to anticipate it. So you have to be in early, because when they always say, buy the rumor, sell the news. It's very, very true. When the news comes out, it's already in the stock.
Well, Dan, we've reached the point in the show where we jump to finest known facts. So we're going to take a quick break, and we should be back in a few minutes.
Welcome back from our break. Before we went to break, we were talking to Dan Hassey about the current state of the stock market. Are we in a bear market? Are we in a recession? You said early on that some of the indicators are showing that it's a bear market, but the big ones, the Dow Jones and the S&P, are not. Which begs the question, do we have to have a recession to have a bear market?
No, but what happens is that we've had several bear markets, 1987 and 1998, where the market fell dramatically, more than that 20%, but there was no recession, earnings were fine, and so those markets were able to recover rather quickly. When you have a recession, you normally have bad earnings, and the market will reflect that, and it takes a little while to recover. It takes a lot longer to recover. So we're probably going to have one of these bear markets with the recession, with bad. So far, actually, if you look at earnings overall, they look horrible because banking and especially banking and financials are such a large part of these indexes that the earnings are coming down. But if you take that out, they look pretty good. So
an interesting article I read from the guys at the Economic Cycle Research Institute out of Columbia University. It was founded by Jeffrey Moore, who built the leading indicators. And what he found through time was, as we were in the 1800s, the recessions were, there were more recessions and they were deeper. And as we progress through time, the recessions have started to get wider and wider between when they occur, and they're also narrower in scope.
very true.
What do you attribute to that, Dan?
I think there's two things. Number one, our economies are much more diverse. If you look back then, they were more agricultural, and then it transformed into more industrial, and now it's industrial. It's also very service-oriented. And service-oriented companies tend to be a little more resilient, that they can lay off workers. They don't have all that brick and mortar that can really create losses very quickly. So that's one thing. And also, if you've talked to the Fed, they think they've gotten better at managing the economy. So the Fed's taking credit for it also, that they can manage these cycles better. Maybe that's true. If you look at Greenspan, we should have had several recessions, but he maneuvered us to kind of avoid these things by lowering rates and working with central banks. This time it's a little more difficult because of rising oil prices and the dollar, and the central banks aren't cooperating.
Hey, a counter to your another question for you related to Greenspan, though, is maybe this is just the big whale that we're going to hit recession-wise, because we escaped it in 2002 because we brought interest rates so low, and then that created the subprime market, which then has gotten us in the mess that we're in now. So the question is, are we paying for our past sins now, and we're going to pay in a much bigger way?
I think that's part of the controversy that's out there, is that we keep on tending to make these bubbles, and actually with the lower rates, you're starting to see some of these commodity prices go up, like gold and oil and some of the wheat, and they're blaming it on that these lower interest rates are causing investors to go into that. So by creating these low interest rates and creating this liquidity, we keep on making these bubbles. And I think this Fed is trying to figure out, how do we avoid that